Just quick introductions. Actually, I'll leave it to Jason, and then everyone can run through and give a 1 to 3 minute high-level overview of what you do, check size, all that fun stuff. Jason is a partner at Goodwin Procter. They're actually my personal attorneys. So you can trust that they are spectacular. They work with a lot of startups and do a lot of great things. And so I will pass it off to Jason as long as he is coming on. Why don't we run through and do our a 1 to 3 minute kind of high level overviews of you, your firm, and kind of what you do. And Alex, we can start with you.
Sure. So I'm Alex Levitt. I work at Snap Yellow, which is an accelerator. Snapchat launched last September. We invest in companies at the intersection of media, entertainment, and technology. So we're primarily focusing on companies who are creating content in some way, shape, or form, or supporting the ecosystem of content creators. Prior to joining Snap Yellow, I was a talent agent at a Hollywood agency representing digital media companies as well as independent creators, YouTubers, Snapchatters, as well as traditional Hollywood directors, actors, and personalities. And so taking that background have brought the sort of deal making and content distribution strategy into the Yellow program.
Awesome. Jason, are you back?
Yeah, can you hear me now?
Yeah, I can hear you now. Perfect. So we're just running through everyone's 1 to 3 minute high level overviews. I'll leave it to you and you can run through starting with you and then Brian next, I guess.
Great. Hi, my name is Jason Breen. I'm a partner at Goodwin's technology and life sciences practice, focusing on the life cycle of startup companies from formation matters all the way through the hopeful eventual exit, either through an IPO or a sale transaction. I work with companies across all different industries, including software companies, biotech companies, all across the spectrum at all different stages.
Excellent. I'll pick it up. I'm Brian Landers with Backstage Capital. We're a very small fund that invests in underrepresented founders. So we primarily invest in women, people of color, and LGBTQ identified founders, all three of which our managing partner and founder, Arlen Hamilton, identifies as herself. If you haven't followed her on Twitter, you should definitely check her out. Arlen was here on Twitter. It's pretty amazing. Get ready for fireworks. So yeah, Backstage, we've had a couple funds. We tend to write 50 to 100K checks. Previous to that, we were writing even smaller checks, like 25K. That's why I mentioned it was a smallish fund, like angel-sized checks. But we also just launched 4 accelerator programs, which are just wrapping up now. There were 3-month programs for startups in Detroit, Philadelphia, Los Angeles, and London. And we had 24 new companies coming through there. So that makes 124 is our investment count now, so in our portfolio. So yeah, I'm excited to chat with you all. Good to see everybody.
Hi, I'm Abba. I work at Wonder Ventures, which is an early stage venture fund based out of Santa Monica. We focus on LA-based pre-seed companies and invest either by leading or co-leading at the first institutional round. We write anywhere up to $500,000 and really take a large stake in the companies that we invest in, making only 5 to 6 investments per year. My background is I started my career on the investment team of the Disney Accelerator, which is Disney's corporate venture arm, and kind of joined as they were scaling up operations, investing in later stage companies. And so we did a lot of growth stage, media and entertainment tech related investments. Then joined Ring on the growth marketing team and was helping define go-to-market strategy along with our user acquisition strategy for both our consumer products and then the digital app that we had launched while I was there. And then stayed through the acquisition by Amazon, got connected to the partner over at Wonder Ventures, and now focusing on helping support the early stage tech ecosystem here in LA.
I guess I'll go next. My name is Jake Liu. I'm actually co-founder and CEO of a local startup here in LA called Outer. We're a DTC e-commerce company focused on furniture. But on the spare time, also an angel investor. So I've been investing for about 3 years now across multiple categories. I have a syndicate of friends that I invest with that normally is cross-border. I'm China and then also the US. I co-invested with a few funds here, including Wonder Venture in a few deals, and Mucker and Craft, etc. My check size generally range from as small as $25,000 all the way up to 150 if it's a syndicate deal. And I'm also a venture scout for one of the Series A funds here in LA as well. Glad to meet everyone.
Hey everyone, my name is Adam Lurie. I work for TenOneTen Ventures. We build and we invest in companies in the creator economy. So we were founded by Ben Grubbs, who was previously head of top creators at YouTube. So on the build side, we sort of have an exec team with some deep digital expertise. It's led by Lauren Schnipper, who is head of creator partnerships at Facebook. And we're really partnering with content creators to build long-lasting companies. On the investment side, which is where I'm squarely at, we're investing in the creator economy. So what we really mean by that is the way people are, we invest in the ways people consume and monetize and distribute content. We write seed stage, where seed stage is sort of our sweet spot with select pre-seeds like Series A, check sizes ranging from 100 to 500,000, with 250 sort of being our average check size. I run day-to-day operations here and for the investment side, work closely with a lot of our portfolio founders and helping them with customer acquisition, go-to-market, and fundraising.
Great. I think that rounds out the introductions. So let's just jump straight into some questions for our various panelists. The first one is what each of you looks for in a portfolio company. And if you could, each of you can also take into account, what are the things that make you excited about writing a check, and also maybe depending on the different stage that you guys are investing, if you're looking at different things for different stages. So maybe start with Adam, since you're on the screen.
Sure. Yeah. Broad perspective, obviously, right? Looking to really be, inspired and excited because whatever this company is doing is really hitting a nerve that we see as either sort of an amazing solution for an unmet need in the creator ecosystem, or sort of pushing boundaries within sort of the creator ecosystem. I think more specifically, we sort of have our criteria around, founders and the team, the product offering, the overall market, the deal terms in the syndicate. As it relates to pre-seed versus seed versus Series A, I think we really like to see, how is everyone sort of testing their hypothesis and executing on that. So we like to see, rapid iteration. So pre-seed, you sort of have a hypothesis, you're testing against that. Seed, you're sort of building flywheels, and Series A, you're sort of running against that. So we sort of like to track progress across each stage and across those categories as well.
Maybe Alexandra next.
Sure. So we're writing $150,000 checks for a standard deal with our accelerator. So our check size does not vary. But as far as what we look for when we invest in a company, I think the first thing is a brand that people can love, that either already shows traction in that way or that we see potential for people to love in the content and media space. I think that's one of the biggest differentiators, is being able to squarely super serve an audience. And so we look for that passion point and that need in the ecosystem for a brand to find future traction. And typically we are Series A, so for most companies, we're first money, and some of our companies have raised a bit of money before coming into the accelerator program.
Hey, Brian?
You bet. Yeah, this is interesting because when you're really early in investment, there's not as many, traction points, proof points, revenue generation going on. So we look for a lot of things early on for things that represent grit, like something where the founder has demonstrated that they have the ability to take their idea to some form of reality, to something that people actually want, to the next round of funding if they're going to go the VC route, which, by the way, we don't recommend for everybody. It's a very particular choice to make to take venture funding. And it puts you a bit on a path toward, high speed growth and continuing to raise more money unless you hit profitability. So we are looking for founders who can get to that next stage of funding. And there's lots of ways that's demonstrated. There's, maybe they've launched something and they've learned something from their audience. They have a growing amount of customers. Maybe they do have revenue. Or maybe there's someone that started something before and, they have already earned a lot of trust based on their previous track record. But most often it's just, sheer hustle and getting their product out into the world because they believe it should exist. The last thing I'll say is also we tend to, it's not a prerequisite, but we tend to invest in founders who have a personal mission aligned with their business. So, we're sector agnostic. So we invest in everything from healthcare, fintech, sex tech, drones. It's all over the place in terms of industries and sectors, but they all seem to have a sort of mission that helps the world and that they very personally connect with, and that they can't imagine the world not having the solution that they're sort of offering to fix whatever sort of thing they're writing. So yeah, I'll leave it there for now.
Hi, I guess I can go next. So yeah, we focus on pre-seed based companies, the pre-seed stage, which usually means just like the first institutional round. It can vary between some founders choosing to do an angel round or looking to bring in an institutional investor. We're lucky that we can kind of fit in between both of those types of investments. And for us, what we truly look for is kind of a lot of things relating to the founders in terms of what is their expertise in the industry that they're building the business in. Do they have domain expertise, or do they have some sort of track record of building and scaling businesses that are venture backed? Also, we look at the team dynamics. So how well does the team know each other? Do they trust each other? A lot of the intangible things that don't seem to come to the forefront of like what you think of in terms of making an investment decision, but we often find are very valuable and are great indicators of a founding team's ability to succeed in the future. And then we also look for something that we call micro traction. So when seed investors say that companies are too early for them, we can kind of sit before them and evaluate a business based off of micro traction. So if the company can demonstrate some sort of repeatability to the business, that's what we found is a great way to demonstrate whether or not they'll have future success. And if you're interested, the partner at our fund, Dustin Rosen, wrote like a little piece on Medium about it that we find is very helpful to share with our investors. With founders.
Jake?
Sure. So I come from a pretty, I guess, a little bit more unique situation where I'm also an early stage founder myself. So I'm really sympathetic to, all the other early stage founders having been through, every step of the way, including maybe approaching accelerators, incubators, to talking to early stage funds, et cetera. So I really look for founders who are preferably co-founders, at least two people, who are, to echo Brian's early point, they have some sort of relevancy to the industry that they're attacking. And, I tend to look for more seemingly niche verticals where, it seems like a smaller market, but, they can generate a really passionate early group of customers or users, whatever the case may be. I really adopt a framework that the founder of Y Combinator, Paul Graham, that he wrote about, which is he looked for people who are persistent, benevolent, and formidable. I feel like it's really good framework. As I look back into the founders I invested in, they all demonstrate that those three qualities, right? It's the grit, it's really the mission oriented, and also they're capable and confident in what they're doing. And lastly, I will add is if I can be helpful in them to their company, whether it's probably don't have time to go help solve day-to-day challenges, operational problems, but if I can leverage my resource in China or a lot of the early stage investors here, if I can actually introduce my investors to them as well, that's something that I really gravitate toward as well.
Great. So next, just want to focus a little bit more on pre-seed investing and what each of the panelists really focus on when you're talking about a pre-seed investment, and maybe just an idea of how you see that changing over the course of the last couple of years and how you may see that changing going forward. So maybe start with Jake again.
Could you repeat the question? Kind of skipped.
Yeah, sure. Focusing on pre-seed and specifically, what would you say are the top factors you're looking for in founders that are forming pre-seed companies? Maybe with a focus on what are you seeing today as to what you're looking for and where you see that maybe evolving over time.
Yeah, I think and again to echo the micro traction, I think that's a really good term. I'm gonna start using that because not necessarily MVPs. I think that's a necessity. Whether it doesn't have to be a very complicated robust technology that's already built out. A lot of it can be kind of in Flintstone mode where they've kind of demonstrated on the manual back end, whether it's spreadsheets or whatever the case may be, but they need to demonstrate an early cohort of customers. If it's consumer app, right, they maybe have test flight or some sort of proof that people are engaging with it, providing feedback. It doesn't have to be perfect. If it's a B2B business, maybe a handful of early customers, business users that are providing them with feedback who I can actually talk to and get their feedback as well. So some sort of early MVP and demonstrating some sort of early traction. Obviously a team that can demonstrate that they can build and execute on the tech side. Nowadays it's easier to find freelancers and also dev shops to build. But if they can actually demonstrate, some sort of internal ability, whether it's a technical co-founder or the team is technical, that's a very, very huge plus as well.
Great. Alexandra, do you want to go next?
Sure. So as far as founders, I think a lot of things have been put out there already by some of the other speakers, and I think we look for similar things. Grit and passion points are really big, knowing that these founders will feel like what they're building has to exist in the world is really important because it speaks to how dedicated they'll be to this in the future. They're at very early stages. There's still a lot to be learned and tested, and their ability to stick with that through the trials and tribulations of finding their way to Series A will be really important to us. So I think that's a really big factor we look for, as well as previous experience and expertise in the area they're tackling. So having a really great idea with maybe some proof of concept, but if the team is not fully built out to tackle what they seek to do, we do look for a team that I think preferably has co-founders or more than one person a part of it to have a support system and to have a more diverse knowledge base to go after what they're building. And because it is so early, I think personally at Yellow we are less focused on specific metrics and more so really founder driven as far as evaluating the team's capabilities.
Great. Adam, do you want to go next?
Sure. Yeah, I mean, I think a lot has sort of been discussed, but the table stakes, right, are sort of dynamic founders that have a clear sort of expertise in what they're doing and are sort of inspiring, can inspire employees, the rest of their team, can inspire investors, customers. I think though, and it gets this idea of micro traction, it's sort of, we look for founders that don't rely on false precision. A lot of times you don't know what you don't know, and we expect that. What I want to see is almost like a commitment to almost like the scientific method, right? Like you have a hypothesis, you're going to go out there and test it. It may be right, in which case, terrific, continue to grow upon that, but also might be wrong. I want to see that you are very competent and confident in sort of routinely testing hypotheses, setting up metrics against that, finding ways to test that out, and then adjusting accordingly, because I think that's what happens a lot pre-seed. And like, you're not going to know what the best user acquisition methods are in the beginning, but can you test that out? And can you test your product in the market? Can you constantly show me that you're really comfortable testing these things? Because from there, that's how we'll gather enough sort of data to then go out and have a successful seed, Series A, et cetera.
Great. Brian, do you want to go next?
Yeah, I just want to piggyback on what Adam's saying there. Process is an amazing thing to see because it almost definitely won't be like you think it will when you launch your startup. Something will change, whether that's the exact offering to customers or what actually sticks with customers, what keeps them excited and keeps them coming back. So you have to have an iterative process by which you discover that. And you can almost assume that it's not going to be exactly what you put out there into the world at first. So definitely at pre-seed, stage, that will be true. So what you're looking for in founders is that ability to kind of test ideas, whether that's scientific sort of thing, and they do lean startup or the ones that Adam was mentioning. I think that's awesome. It can be also sort of intuitive or, as long as you get to the same progress points, I think it's okay. Like there doesn't have to be one way in which you do it. There's no sort of, one framework that everyone needs to do, but those are very valid and excellent ones. And then I would just say also that I've noticed, I think I've been in startups now for about, 20 or 30 years or something. And I've definitely noticed that things have changed over the years of what traction is expected for just having conversations with investors. So it depends a lot on what sector and kind of what, user you're serving. But the numbers have definitely gone up, and it's no longer just people who are just talking about ideas are very much in a different sort of bucket than people who have executed on anything to do with their idea. So if you have a prototype, you've got research that you talk to customers, like customer research, pretty much anything you can show that you've made progress toward making this a reality, you will be ahead of all the people who are just sort of have an idea and sort of maybe they're looking for a technical co-founder or they just need money to make their idea work, which we hear a lot as investors. That's not super convincing when there's really competitive companies that are, stacking up to apply to incubators, the programs for folks on this panel, and just people's funds. So you have to remember that it is a competitive landscape, and the traction part is super important. So yeah, starting is super important, but then showing some traction one way or another, whatever that means for your business, is crucial.
Abba?
Yeah, so I think everyone who went before me kind of brought up some really strong points. Don't want to be too repetitive here, but I think the main things to focus on are really your core team when you start building a business is incredibly valuable. So how can you recruit people that will be high value and efficient in the output of the work that you're doing? So much is going to be in the unknown. So you want to be recruiting people that you trust and know will go through the depths of this business, without giving up super quickly or at all for the next foreseeable future. Also, you really want to make sure that you can find interesting and unique distribution channels for whatever your product is. So customer acquisition on Facebook and Google AdWords can be really expensive, but are there maybe other more cost-effective ways to be acquiring customers? Also just demonstrating some sort of trajectory for growth that's measurable. So if each month you're demonstrating that your revenue numbers are growing in a way that demonstrates this is a business that can scale with spend and with more access to capital, I think that's what a lot of investors are looking for. So yeah.
Great. Each of the panelists has mentioned traction in their discussions, and just wondered if some of you could address what traction starts to look like as you get out of pre-seed and you start getting to seed or getting to Series A. So maybe Abba, maybe you could start.
Yeah, for sure. So I'd say that when my conversations with a lot of our follow-on investors, a lot of the seed investment firms that we work with, they are similarly looking for, they have specific metrics that they have in mind, like some level of monthly recurring revenue that kind of fits with their target as a fund. And a lot of that just comes with conversations with seed investors that you develop relationships with over time. And one of the most beneficial things that we found is you should start your conversation with seed investors before you're looking to fundraise, because once you show up to them looking for money without having a demonstrated understanding of the relationship that they're looking for and the sort of expectations of the business that they're looking for, it's really difficult for them to just take one data point of you have a first introduction with the seed investor and then they are supposed to make a decision within some sort of timeline. But if you've built a relationship over time, that's an easier way to understand, like, what are they looking for? How can you demonstrate and hit those metrics so that you can set yourself up for success in the future? Also, something that I think is important is when you're evaluating different businesses in venture, it really varies by industry. And that's why I'm hesitant to kind of establish any hard set metrics on how you should evaluate a business at each stage. When I was working at Disney, it was vastly different than the things that I'm looking at now at Wonder Ventures. And part of that is just because different industries have different rates of growth. And that is a very important thing to keep in mind as a founder, that you shouldn't have one applied framework. You should really get to know the industry and the sector that you're working in and have a better understanding of how can you demonstrate great potential based off of the industry that you're in.
Alexandra?
Yeah, so I think similarly, while we are focused at Yellow specifically on content and media, our business, the companies we invest in tend to still have all different business models and maybe targeting different portions of that, or, you know, I think our thesis can still be interpreted rather broadly. So some of these are tech powered and some of these are more like a BuzzFeed Vice production digital media company. So traction for all of these businesses will be significantly different based on what their products are, whether it is proving an audience for their good, and it's going to be more so their engagement or presence online, or if it's proving traction in terms of revenue or some other metric. So I think, again, it's hard to put one specific metric on it. But I think what we find specifically, and not to be repetitive from some of my previous answers, when a founder is really passionate about something and can prove to seed investors that they have that ideal communication, they can find that passion with their audience. I think that's really compelling to show that they've found the way to speak to the group they're targeting better than anybody else can.
Adam, do you want to go next?
Sure. I think, yeah, the responses thus far have really been terrific. You know, obviously it sort of depends on the sector. Some firms do have sort of clear marks of traction, but I think for us, because we're sort of a little more agnostic within digital media, we're looking for proof of a working concept. Again, this is sort of building on everything that's been said, but it's, you know, do you have a working concept for how you're, you know, attracting customers, how you're engaging them, what that loyalty loop sets up looks like? It doesn't have to be fully set up yet, but I want to see that you have working processes that with the sort of completion of this seed round of funding, you're going to be able to put resources into that to really build those out and really get them to start spinning, so you're set up sort of future success. So sort of the proof of sort of working processes and showing what that looks like over time is really important for us when we're looking at seed stage companies.
Brian?
Yeah, just to try to add something new to the conversation from what, as Adam said, like every response has been awesome so far. I love you all. But yeah, like I think take some power back into your own hands. These numbers are out there. You have peers that are in similar sectors as you. Ask them where they're at with metrics. Talk to investors before you're ready to raise and ask, you know, what are the de-risking points? Like what kind of metrics are you looking for at this stage? Because when you're not actually asking for money, it doesn't look like you're, you know, showing up to a job interview without knowing the right answer or whatever. So you can kind of do a little bit of research beforehand. There's also just tons of good information online now. There was a Medium article linked earlier from ABBA, and then there's like, you know, gosh, SaaStr, there's conferences for this stuff, which if you can't get to, there's still plenty of stuff online. So I would say just, yeah, don't forget that you have a lot of power to find this information out yourself, and that networking to find that information is going to be crucial to your success as a founder. So yeah, so the power is yours.
I think Jake, you're last.
Cool. So I'll speak to the two specific categories that I personally have experience in building companies in. And The first one is in B2B. And specifically, if it's B2B SaaS, whether it's enterprise or to SMBs, I think finding some sort of, repeatable, measurable sales funnel and the conversion rate at each funnel and, how long it takes to close a deal, et cetera. It's important to find, scalable acquisition channels. In this case, channel partnerships. Can you demonstrate, a few that can bring in you, outsized returns as far as customer acquisition goes. On the B2C side, obviously, it's depending on what it is, but specifically e-commerce, right? Besides the very obvious points of customer acquisition cost and lifetime value and average order value and all of that, and there a lot of literature online for that. But I think one thing that I specifically look for nowadays, whether it's an app or a brand, I look for what's called brand love or social proof. So whether that's reviews on App Store or social media comments and how people actually talk about your brand, I think that's kind of hard to measure, but you can get a good sense in just seeing how the social media or your customer base is reacting to you. So those are little things that I look in, as a company scale from pre-seed to seed, even from C to A.
Great. There's a question on the chat that is around whether or not these metrics should be put into your deck. Maybe, Jake, if you could just speak to that a little bit.
Yeah, I mean, on the deck, you're definitely trying to show, velocity and growth, and you're showing all the exciting things. So definitely, put that in there. Especially if you can show some sort of growth month over month, if that's a metric that you're measuring. So yes, put it in the deck. I'm sure nothing's going to be perfect. So the challenges will come out in that conversation, but in the deck, you should definitely show the best side to capture the attention.
Great.
I can kind of go next on this. I definitely agree. I think your deck should be your demonstration of the top most compelling aspects of your business. So what are there, and there are so many wonderful examples of decks online of companies that you can probably also access on Product Hunt. I remember in the past, like Uber, Airbnb, DoorDash, all of their decks from when they first pitched. And they're just good frameworks because in a deck, you should be able to synthesize the top most relevant aspects of your business and communicate that in a short amount of slides. So I'd say no more than like 13 slides max, but in 11 slides, you should be able to communicate everything. And it's kind of like your thesis statement about your business, like discuss who the founders are, what their relevant experience is, why they should be building the business, why now, the size of the market, kind of what your distribution channels are, what competition looks like, and all of the most, it's basically like a mini pitch condensed into your slide deck, and it should be the top level points so that if you continue the conversation with an investor, you can kind of go into more depth about all the things that you've discussed in your deck.
Great. So maybe for the next question, a lot of companies end up having a lot of problems after they've gotten the pre-seed money or the seed money, making the jump to Series A. Wondered if you guys had a view on, one, why that's so difficult, and some suggestions for the participants on how to try to make that jump. Maybe Brian first.
Yeah, I'll take that one first to take the easy, low-hanging fruit here. I think number one, we have to recognize that funding stages are getting larger and larger. So what used to be Series A, we now call probably like pre-seed. It's just the nature of the way the market's moving. There's a lot of reasons why. I'm not even an expert at that, but there's plenty of stuff online if you want to dig in on why. But like the difference between what traction is required for investing in a Series A company versus a pre-seed or friends and family round is just a huge difference in terms of where you're at with your business. There's no way to kind of tell a story around a Series A company that's not having traction, that's not growing, that doesn't have good revenue if it's a revenue generating company. Whereas you kind of can do that earlier on. You can make it look more optimistic. You can, the future is untold as to what will be happening. But the later you get in sort of funding rounds, the more that stuff is established, so that by the time you're at Series A, you're really growing a business that's working. Hopefully you have product market fit. You know, all this venture money is going to really explode the growth. It's the pouring gasoline on the flames kind of a thing. So you got to have flames, good flames. That sounds very dramatic, but so that's part of it. And then I'd also say that less and less companies are being funded at the Series A level, just, you know, statistically. So it's just an odds game. Like, you have to have an incredible business that's enticing to investors who invest at that stage to be able to secure that funding. So the bar goes up, you know, traction has to be higher. It's raising more money, so you have to be more mature in your business, and that sort of all leads to what you're describing, Jason.
Great. Adam, do you want to go next?
Sure. Yeah, I think it's, you know, it's difficult because sort of part what Brian talked about is you have to show, not tell, right? With pre-seed and even seed, there's an element of, you know, you don't know the future, so you can sort of sell almost based on a story. So sort of like, you know, cheesy analogy, but if pre-seed is sort of setting up the launch pad and seed is building the rocket ship. Now, Series A is actually like, that's a liftoff. And so there's a big gap. There's going to be a lot more scrutiny around everything you've been doing to date. So, I mean, I think to sort of prepare for that, one is think about Series A when you're raising pre-seed. Like, what are the metrics you're going to be measuring the entire time? What KPIs are you going to be measuring? What are going to be the through line narrative points that you'll be able to say, yep, we said we wanted to do this, we did this, now we're ready to do this, and it should be sort of a straightforward conversation. And then I think also, back to what Abba said, was start relationships with investors early. Like, even when you're not fundraising, even when you're fundraising earlier rounds, the more you can have those relationships, and again, sort of seek help versus seeking money, I think the more set up you'll be for an eventual Series A.
Alexandra, do you want to go next?
Yeah, sure. So I think, like everyone sort of laid out, the standard or the bar is definitely higher for Series A, I think, now than maybe it was a number of years ago, as sort of the stages and the rounds get larger. I think one thing particularly, I can speak from the Yellow sort of accelerator program point of view, is I find most of the companies that come into the program, one of the biggest challenges they seek in moving from pre-seed to A is prioritization. They have a lot of ideas that they want to test. They want to build the cruise ship, but in order to get to the cruise ship, they have to pass that Series A bar. And so prioritizing what metrics and what few measurable pieces of growth they can focus on for a shortened sprint in order to get to that A is really important. Small growth, I think, across a large number of metrics doesn't build as good of a story as 3 months of massive growth in one metric. And so I think that's one of the biggest challenges that I find most founders have in moving from stage to stage, is making sure that they're keeping their eye on the ball of one thing rather than trying to build every idea that comes to mind in that time period.
Abba, do you want to go next?
Yeah, I mean, I think that a lot of the things that were said were very well articulated, and just really understanding how can you demonstrate and bring your business and your founding team at the forefront of your investment conversation, and how can you leverage the things that you've done in the past to make sure that they're really well represented in any sort of investment conversation. And a lot of it is also getting reps in, and to some degree, like, your first pitch isn't going to be your best, so how can you continue to practice with various different people who are in the industry, people who are not in this industry, get a different set of eyes, just to make sure that you're really optimizing for success and making sure that you can present your business in the best way possible.
Great. So Jake, you're next.
Yeah, so I guess I'll just add 2 more points. The first one is, there's a really great blog post by prolific Series A investor in LA, Mark Suster. He wrote about, investors invest in lines, not in, dots, especially for Series A investors, because they have data points to look back on, right? So you're trying to show this growth trajectory. So, basically, you can also go to Series A investors to build that relationship early, check in, always set, the moment you meet them, they're going to set up expectation of your growth, right? So from the first time you meet them to the second time you're going to meet them, show some sort of trajectory, don't overpromise and underdeliver the other way, and always show a story of progress and iteration as you kind of court that relationship. That's one. And the second one is really, depends on, I'm not too sure if the audience is mostly in LA here or not, but, in LA, you have very limited options when it comes to Series A. So that's definitely a constraint. And so, be very tactical about how you approach Series A investors. Really distill it down to the sector, find the partners, not just the funds, the partners that really look at your sector, and then, start those relationships early again, but then go to the Bay Area, right? Start conversations there as well, generate some momentum, and just get use a CRM to track who you're talking to and treat it like a sales funnel almost, right? And just be really efficient at doing that as well. So those are the two additional points.
Great. So the next question is, what, if anything, you see companies that actually get Series A funding doing differently that companies that may have great ideas and were very successful in raising seed funding, but weren't able to make that jump?
We can talk about this. A lot of it is just getting distracted, and at every point of your business, you want to have core focus around what you're building and make sure that that core focus is continuing to be met, but then also adjusting at each stage of growth. And I also think it's really important to make sure that you reflect very periodically on your business. So in the early stages, every 2 weeks, reflect, check in, make sure that all of the kind of hypotheses that you've set up around your business and whether or not it's meeting all of those tests, or if you're achieving all of your conclusions, then reframing the way that you're thinking about your business and making sure to consistently adjust your business accordingly. And so in the early stages, it's going to be more of a consistent check-in on maybe every 2 weeks, on that sort of cadence. But then as you continue to progress, it could be every quarter or every month, just depending on where you're at in the stage of business.
I'm happy to jump in here. I think a number of people have talked about the importance of how much of a full-time job raising can also be, and the importance of building relationships with investors really early on. But I think also people sometimes lose sight of the pure scale of number of investors you often need to talk to in order to find the right fit for your company. I've heard some people advise that to raise around, at least in A, you should probably talk to a minimum of 75 investors. I think other people have different opinions on exactly what that number should be, but I think what is surprising is how people may give up after 10, 15, or even 20 conversations, and not necessarily realize how many conversations are necessary to find that perfect fit for their company. So I'd advise not to give up too soon.
Brian, did you have something? Yeah.
What was it? I did have something. I'm trying to. What was the original question, by the way? Just so I.
What are differentiators for companies that are getting through to Series A?
I got it. Alex's answer was so good that I lost mine. Okay, here we go. So I would say number one, just getting in the most frequent habit of shipping. You would just have to take next step. There's no way to get to, that level of funding or, progress or traction or user interaction without just sort of putting one foot in front of the other over and over and over. Adam alluded to the sort of processes that you can take to kind of do that and test your hypotheses, see if it's working. But there's just no one I've ever seen has reached that point without being a shipping machine. Going through fast iteration cycles. That is the biggest advantage of startups over big corporations that have way more money than you to market, to educate their, potential customer base. They could hire your team faster than you can, but you can move a lot faster. And you can learn something that they won't learn. It'll take them 2 years to learn something you can do in a couple months. That's the superpower of the startup. So I would say shipping iteration. So execution. And then also you'd have to call it out that you have to make something people want. If you aren't serving customers, if it's a social app or something sort of a human need, no amount of funding is going to sort of make that work. So you have to have something that people really want, and that is what will get you to that next level of scale. And so that might mean completely changing what you started with, or just refining it to be more what people want. But cutting out that side of the equation would be a mistake, I think.
Great. Adam, do you want to go next?
Sure. I think a lot of great things have been said. The sort of two things that I see are, one, no one will fund just a sort of continuation of the status quo. I think a lot of people will going out for the Series A, and it's not all that dissimilar than what you sort of saw in a Series Seed. And there needs to be obviously a step function of difference. And then I also want to go back to something Alexandra said, which I think is spot on. A lot of companies, I think, focus on doing too much. So it's, hey, we have some traction with consumers and we have some traction with enterprise clients. But without actually being able to prove one thing, it's really hard to go out and back something, because you want to know that when things start to, inevitably, if things go poorly or if something unexpected happens, you have that sort of core base that you're leaning on. So if you say, we have a really, really strong consumer base, we got that in the line. We have workings with an enterprise, that's a lot better than half and half, because I know that if all else goes wrong, we can focus on consumer, and that's sort of our foundation versus sort of being in between a bunch of different areas.
Great. Jake?
I'll just add one more point, which is I found that a lot of C-stage startups, if the founder is able to attract, kind of like punch above their weight class and attract really senior talent, whether it's from established businesses, poaching from, the competitors that are more established, that's always a good sign. You can court senior level talent to basically join still yet a very early startup. That demonstrate your ability to kind of build the team and continue to scale that. That's something that I think a lot of Series A investors really value.
Great. So it sounds like most of you are investing at earlier stages, or at the earliest Series A. Are you guys investing in the follow-on rounds after your initial investments? And if so, is there anything else you can add as to what you're looking for to put in money into the next round?
I'll start. I typically don't do, I guess, if I can keep my pro rata, if there's pro rata, then I typically, exercise that if I can, but generally don't participate in Series A.
Anybody that does?
We reserve around like 1/3 of our fund for follow-on capital. And a lot of the times it's, we work really closely with our companies that we're investing in, since we're investing at the first institutional round. And what that means for us is we have a pretty consistent cadence of how consistently we're communicating with our portfolio companies. And we have a good understanding of what what different businesses look like. And based off of that, we can make pretty quick judgments around whether or not we'd like to continue to invest in a company. And usually we feel like we put in, and founders have put in, a great amount of work so that we feel comfortable enough to invest in companies in successive rounds.
Great. Next question is around where you put value in revenue versus users, and if that's evolved over time, and where your current thinking is on what's the most important metric. Abed, do you want to go first since you're up?
Yeah, could you repeat the question?
Yeah, sure. At this point, do you value users or revenue-based ventures as the new normal as to what you're looking at, as to be what's most important when you're deciding whether to make an investment?
Once again, I think that it really is a combination of things. If you have a kind of binary approach to investing, I don't think that's a great way to determine whether or not a business can scale and is venture backable. If you guys are able to participate in the chat, I actually linked the article on microtraction, which goes into more specific detail around like what sort of things you should be thinking about in the early stages of building your business. But in terms of user groups, I think it's really important for founders to spend time understanding who their core demographic will be. And of course, you can't have a complete holistic understanding because it's so early in the business, but I think you can definitely get a pretty good understanding of what user groups might fall into your typical customer. And as long as you've identified that and can continue to prove out whether or not that's correct, or what things you might need to modify in order to have a better understanding of that, I think that's the most important thing that you can focus on in terms of user groups. And then in terms of revenue, it's really understanding, one, what type of business are you building? It's gonna vary based off of the industry. And then also, how are you able to demonstrate repeatability of the business, as we talked about multiple times before.
Adam, do you want to take this question on too?
Yeah, I think revenue and users, they're great sort of headliners, especially in a deck. What we're really interested in, I think a lot of investors are interested in, is what are the underlying factors that are fueling those metrics? Because that's really what's important, and it's going to depend on the sector you're in. So, if you're a budding social media platform, revenue expectations are pretty much zero until probably Series B. What I'm interested in is users, but going deeper than that, like, what are the engagement metrics? What's the daily active users? What's the monthly active users? What's the time spent? It's really if those underlying factors are healthy and you know what is generating them and how to sort of pull the levers to increase that, then revenue and everything else will come from there. But it's really about sort of those healthy base metrics, depending on what industry that you're in, that will then fuel those more headline metrics around users, revenue, et cetera.
Great. Alexandra?
Yeah, I tend to agree with that. I think especially for the companies in the sector we're looking at in media and content, scale, engagement, definitely supersede revenue. I think if you can bring a large enough audience to your brand or product, you are afforded the time and flexibility to figure out how to monetize them a bit better later on. I work at Snapchat. It's a public company that is not profitable. So I think, looking from that perspective too, scale has afforded Snap the ability to experiment with its revenue models and different products over time.
Great. Brian?
Yeah, I guess what I want to bring up is that growth is sort of we've heard it a couple times on this panel so far about showing progress and showing a progression of these milestones. So I think that like growth is something that investors also look for. So it's not just a straight, like you have to have this number by this time. It's like, how fast did you get to that number? Did it take you 5 years? Did it take you, a month? That's a really big difference in terms of how potentially fast your business can grow. In terms of, I don't think it's like there's no sort of dichotomy between users and revenue. I think like every business like early on probably has at least 1 to 3 key metrics that sort of drive the growth of the business. So it's up to you to figure out what those are. Sometimes it's going to be, I would probably guess that it won't be users for the most part. If you have users, hopefully you have re-engaged users. Like, do they come back? Because if a user comes just once and then bounces forever, your business has a very leaky bucket. And so, you probably won't be able to continue earning money from them. So you have to have an incredibly high price point, which is unlikely because people don't like to spend money on things. Well, that's not true. They do like to spend money on things. But where the high price point is a harder decision, et cetera. So yeah, I would say learn what those metrics are for your business, and then just like have a dashboard, where you just watch that weekly if you can. I don't know. It depends on what pace your business is. Some healthcare startups we work with are doing FDA approval for hardware devices. That's a very different cycle than Snapchat, for instance. So, know your business is going to be a little bit different for where you are and where you're going, but know what those metrics are, know how to communicate about them to your employees, your team, your investors, yourself, and be really honest with those and try to improve them. And, I think you definitely need to be measuring things, because otherwise you won't know if you're growing and you won't know what strategy to take toward that growth.
Great. Jake, do you want to do that?
Yeah, so I think this, the answer is probably going to differ a lot from VCs and from angels. Speaking from an angel's perspective, I really, value teams that are super scrappy and they can demonstrate, ability to monetize. Probably also a factor of I haven't invested in any social media platforms. So, I count on, basically the early stage companies to demonstrate ability to generate early revenue so they can get to even break even. I can, you think of two companies that one company is kind of like in subscription commerce, content commerce space. And they use $50,000, to build a $25,000 MRR business, like that sort of scrappiness. I mean, that's, a lot to ask for, but, that's really good. And they've, gone on to raise Series A. A company that Wonder Venture and I co-invested in, they essentially started out of the gate with paying customers. It's in the logistics space, right? And so I think I gravitate toward revenue, especially given the startups I personally look at, and especially in LA. So I'll give a more polarized answer for that one.
And another question is around how entrepreneurs would reach out to you. I mean, there was a comment earlier that people should reach out to 75 potential investors in order to raise a round. How do people go about reaching out to that many investors? What's the best way that you view as people getting your attention?
Yeah, I can go first with this one. We will look through every cold email that we get. I will say that your best bet is to get a warm introduction, to kind of have a conversation with our fund. And part of that just comes from a level of trust if we're getting some sort of introduction through a mutual connection. And that is usually just a good rule of thumb for all sort of investor conversations. If you can find a mutual connection that could reach out to the investor ahead of time and ask them if they're open to an introduction, it's your one step above kind of like the mass sort of influx and inbound of, company deal flow that we get otherwise.
I have a more of a unique situation. A lot of early stage founders reach out to me, to basically ask for advice. How should I approach early stage investors or incubators, accelerators? So they don't necessarily approach me for investment. So essentially reaching out to other entrepreneurs is a good idea because, especially entrepreneurs who are venture backed, because if you can convince that entrepreneur that, you're working on something that's, pretty awesome. And then if they would invest, if they could, they'll probably, offer to introduce you to their investors. Right. And that's a really good warm introduction you can get. Another thing is, if you're talking to, I would say, if it's a cold outreach, usually, we all get bombarded by LinkedIn messages. I still don't know why people send like 5-paragraph, messages on LinkedIn, which, I just kind of dismiss right away. But if it's like a short, sweet message that kind of, it's kind of like applying to a job, right? Like if it's cold outreach, at least put some attention, some effort into researching who you're reaching out to. And, if there's common language, whether if it's a VC, have they invested in that sector that you're in? But by far, warm introduction, and if it's cold outreach, just be succinct and don't send your business plan in like 5 paragraphs. That's my personal preference anyway.
Adam, do you want to go next?
Yeah, I'd say cold hard cash is just the best way to engage. Joking. The warm introduction is always great. If you're reaching out, I'll absolutely look at your email. The thing is, like, I want to know why you emailed me specifically. Short, sweet is good. Also, just like having some background who I am. The sort of standard mass email doesn't really work nearly as well. And then it sort of goes back to, if possible, asking for help around especially a specific, or advice around something specific, usually goes a little bit further than money, because it shows you forward thinking. And also there's not this like, it desensitizes me that I love to help people. A question around investment is a different type of question. So I think when you reach out to investors, at least for me personally, it goes a little bit further. But if nothing else, make it personalized, make it relatively short and sweet, and make it based around my expertise and my background.
Brian, do you want to go?
Yeah, these are all great tips so far. I mean, I think people forget that, investors, just like entrepreneurs, are humans, right? Like when you go to talk to an investor at a, event that you're at, and like, you go into like pitch mode and you have your like, 3-minute thing and you don't let anyone else speak and you're on this, roller coaster rails that you have to stay on. It's hard to remember that like VCs are just humans out there with their family and, all their worries, and they're raising money from limited partners. So they're just like you in that sense. Maybe they're not even like funding right now. Maybe they can't write checks because they're in between funds. Actually, our applications are closed right now for Backstage Accelerator. So like we're kind of in that situation right now, just to be totally honest with you. And we have open applications, so we let anybody apply. Because what Sonia said in the comments is absolutely true, that warm introductions do put up a barrier for a lot of people who don't have access to certain networks. Maybe they didn't go to Ivy League schools, maybe they didn't go to business school, so they don't know investors. That's why friends and family rounds are so hard for underrepresented founders traditionally. But I would say just what Adam said is like, customize it for the person because they're humans. Like, how would you answer an email? You'd want it to be something that's interesting to you, something you can easily answer. I know that when I get that 5-paragraph email, like Jake was talking about, like it's going to either just sit in my inbox for a long time until I archive it, or, if there's something in there I can get a quick answer out, I'll do it. But if it's like too much stuff to respond to, it just won't get processed. So make it really easy to get that turnaround super fast. Like if it's a quick ask, hey, what do you recommend for this one specific thing? Because I know you have experience with that. Boom, you can just answer that email really fast. And then just know, do your research, run a process, have a spreadsheet or an Airtable or something where you put a list of investors that are in your target, that in your sector that have invested in companies like yours or are likely to invest in you, and just go for it. I mean, you have to be organized about it. You have to be, do everything you can to educate yourself about those conversations. And it's a lot of work. So just don't think it's going to be easy, and don't think that, if you get lucky, that'll be great, but don't plan for that. That's what I would say.
Great. Alexandra, I think you're last.
Yeah, so for the Yellow Accelerator specifically, we have open applications, so anybody can apply. Referrals and warm introductions definitely always are helpful, and I think like a lot of people have said, often to form those relationships, reaching out for advice rather than a specific investment ask often yields better conversation. I think as we're reminded that investors are human, people like to give back and to advise. Like we're all in this because we like to work with founders, I believe. So that I think yields more response, at least for me personally. I think as far as cold emails, those are harder for us to reply to at Yellow just because we do have an open application process. If you're interested, then we want to see you go through that application rather than shoot over a note, especially because of the pure volume that we are digging through during the application period. But we're always open to forming relationships and hearing about the progress of companies, even in between our open application periods. So, I think just avoiding some of the common mistakes that people have, the copy and paste emails that feel very cold and non-personalized, are less effective. I think it's amazing how many times I get a copy paste email that goes to me. We're a 2-person team at Yellow. They go to my my counterpart at the same exact time, and it's often very clear when somebody has not even gone to our Yellow website, right? So really think about the person you're reaching out to and why you think it's worth their time and what you want to gain from a conversation with them to help contextualize why they should spend their time speaking with you.
Great. Well, thanks for the panel for all those answers. It was really informative. And Lucas, should I turn it back to you?
Sure, sounds great. Appreciate it, Jason. Thank you, everyone, for being on the panel. I know that you guys are incredibly busy right now. A couple of you are actually in cohort for the accelerator currently, so super wild. Really appreciate you taking the time to come and be able to help educate some of the entrepreneurs here.